Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks, they are rallying, led by Apple gains, and we're going to dive in depth in that in just a moment. Plus, President Trump is doubling India's tariffs in response to buying Russian oil. Right now, let's check where the market's at with just an hour to go into the closing bell. Stocks moving higher. Green across your screen. Dow's up about 100 points. S&P 500, your broad gauge, is up about 0.7%. And your tech-heavy NASDAQ, that is up about 1.2%. Let's welcome in here. We have Jessica Inskip, Director of Investor Research at stockbroker.com. Got Washington correspondent Ben Worschel and Senior Markets reporter Josh Schaefer, all joining us now to break down the headlines. Kicking off with you, Josh, with the latest on today's trade action so far.
Hey, Josh, surprise, surprise. We have a tech rally leading stocks higher. So you take a look at the Dow Jones Industrial Average. That is up about 100 points. The S&P 500 is up about 0.75%. But again, your NASDAQ, the tech heavy of the three majors, leading the way up over 1%. I'm going to flip over to some charts here and just take a look at some other broad action we've been following this week. Remember, we had talked earlier this week about the Russell 2000 had been leading the last 2 days as interest rates fell lower. The Russell not having as good of a day today. That's a little bit in the red. The same could be said for the S&P 500 equal weight index. Remember, when a lot of stocks are outperforming the S&P 500, usually you'll see that equal weight outperform. Today, we're looking at more of a mega cap tech rally, so that's not quite happening either. I want to hit two other things before we take a look inside some individual movers. We'll take a look at the 10-year T-note here. That's sitting at 4.22%, not moving much, up about 2 basis points today. And then I want to take a look, though, at some individual movers. Really, the story of the markets this week has been big moves on earnings. So you take a look here, Super Micro Computer off 18% after disappointing on sales estimates. Shopify, an opposite story. That stock up 20%. But really the story of the day here, guys, is Apple. That stock is up over 6% or nearly 6% as we await CEO Tim Cook and President Trump to be speaking at the White House coming in the next hour about Apple's investments in the U.S. I mentioned Apple driving this action today. Well, if we look inside the NASDAQ 100, it's Apple up 5%, Amazon up over 3%, Broadcom up over 3%, Tesla up over 3%. Again, large cap tech, really sort of the bias here. If we take a look from a sector perspective, you'll see a similar theme playing out. Consumer discretionary. Remember, Amazon is not in the tech sector. Amazon is here. Tesla is here. That sector is up almost 2%. Tech is leading as well, tech up over 1%. A final look at our leaders board here, just to see what's leading from a index perspective. The IPO ETF up over 4%. Again, MAGS, this is the MAG 7 ETF that encompasses all of those large caps. That's up about 2%. But Josh, really, I think the story of the day, we write and talk about the stock market here every day. It has been a while since we have highlighted this stock here, AAPL, and been talking about that driving a tech rally in the market. That's what we're seeing here today. Apple's really driving that action. For sure, Josh. All right, Jessica, also want to get you in here. What are your takeaways from what you're seeing so far in the session, Jessica?
Well, I really do think it's interesting to see how we're narrowing down to tech once again, and I echo what Josh is saying. When we're talking about Apple, that's very much a big deal. And I've noticed that the hyperscalers, they've really had this injection of cash from fiscal policy because of what happened with the BBB bill. So that's helping them. They're spending more. There's a lot of AI spending, but now with this Apple story, I find it very interesting that this has to do with almost negotiation tactics, and I really want to see what Tim Cook is going to see later on. But also what we haven't really discussed is what's happening with the US dollar. That has been weakening. That is very good for technology. So there's a lot that is really setting up this environment that could be a narrow rally, but good for technology. And if it's narrow, it's a bigger piece of the market cap weighted index. So it could hold up the overall market. And we're seeing that especially with what's happening with the equal weight as well.
Yeah, soft dollar tailwind for those multinationals. As to our top story, we mentioned investors we know eyeing tariff news very closely. And today we're learning President Trump implemented an additional 25% tariff on India. And that's days after he already imposed a 25% levy on that major trading partner. Ben, catch us up on the very latest.
For sure. It's been a bit of a double whammy this week for India on the trade front. What we have, as you mentioned, is a 25% reciprocal tariff. That's due to go into effect in a few hours' time at midnight tonight. And then what he announced today was an additional 25% tariff. That's the timeline on that is about 3 weeks from now. And that is over the country's consumption of Russian oil. Those will stack together. So this would be a 50% tariff if both of those go into place. There is a lot of questions this hour about whether those additional 25% tariffs to get us up to 50 will indeed go into place, because this is clearly a kind of indirect way to pressure Russia to end the war in Ukraine, or at least agree to a ceasefire for right now. So indirectly from India, but also directly today from Trump's envoy, Steve Witkoff, who was in Moscow and met with Vladimir Putin earlier today. President Trump posted a few hours ago that there was great progress made at that meeting, but he did appear to acknowledge that a deadline he'd set for this Friday for a ceasefire is going to slip. So this is going to be an issue going forward, and how India gets kind of wrapped into it for certain is up in the air. Also on the Indian side, we've seen another flurry of really negative responses from Indian officials to this latest move. The word from India's External Affairs Ministry was unjustified, unfair, and unreasonable. And then a headline that really caught my eye that I think gets the larger picture here is that we have reports that Narendra Modi, the Prime Minister of India, is set to travel to China later this month. You'd think that would be routine, but it's actually not. That's reportedly, if that goes forward, it'd be the first time in 7 years that Modi has been to China. So that would be a big step kind of away from the U.S. towards China.
Are we surprised, Ben, that the friction here between the U.S. and China? I mean, maybe not, only because, listen, we were hearing these Trump officials. I think of recent interviews, Besson, for example, was giving to reporters and was clearly expressing his frustration. But I'm just wondering whether you're surprised at all by where we find ourselves here.
Yeah, in the larger frame, I am very surprised. There was a sense very early on in Trump's administration that India would be kind of one of the easier ones to work out, that there was a friendship between Trump and Modi that went back to his first term. That has clearly changed, and the word Besson has used is frustrated. You hear that from a lot of Trump teams. I think that comes down to a couple things. One is that India has stood up to Trump's trade demands in a lot of respects. They're not willing to lower a lot of their high tariffs that are in place. It's also this long-term connection with Russia that they have. This goes back decades. They get a lot of energy resources from Russia. They also have deep political connections there that I think the Trump administration may have underestimated how close they are on that. And so that's going to be a much longer fight than we might have expected a few months ago when India was kind of seen as perhaps first out the gate.
All right. Thank you, Ben, and thank you, Josh. Appreciate it. Well, for more on tariffs and potential risks to the market, we have Michael Sayers, Rockland Trust Vice President and Portfolio Manager. Michael, always good to see you on the show. So why don't we start with tariffs front and center, certainly helping to dominate headlines, say, Michael. White House saying an additional 25% tariff will now be imposed on India. So the total now there is 50%. How do you try, Michael, to try to sort of think through these trade and tariff headlines? How do you try to navigate them as an investor?
Yeah, well, thanks, Josh, for having me back on the show. I think for us, we try and do our best to actually kind of ignore the day-to-day, because, we know this is kind of going to be a constant, I think, of the Trump administration for the next 4 years or so. I think importantly, though, a big company like Apple actually seems to have gotten a carve out from that additional 25%. Higher for the tariffs on India, so that's very important to pay attention to. But for us, when we dig into our companies and dig into the fundamentals, that's kind of where we evaluate, on a case by case basis, which companies are going to be more or less affected by the tariffs, and then we just look for dislocations in the market. If we think certain companies sell off more than they should based on tariff headlines, and that may be a buying opportunity for some of the stocks in our portfolios.
So for you, Michael, although they may get a lot of attention, the trade and tariff headlines, they don't change how you want to commit capital or where you want to commit capital.
No, not in the long run. We're long-term focused investors, really just buying quality businesses. So, for us, that's kind of our bread and butter. And on the margin, in the short term, sure, the tariffs will affect earnings in the next few quarters. But, once the tariff rates are finally set, and I think we are getting to the point where we're getting closer to the finalized tariff rates, then it'll be kind of a one-time adjustment to company earnings. And then from there, the longer-term fundamentals in those businesses can take over.
You mentioned earnings, Michael. Let's talk about this earnings season. You got another rush of names, of course, after the bell today. What have you learned about this earnings season? What have been your big takeaways, Michael?
Sure. So coming into the week, about 70% of S&P 500 companies have reported second quarter earnings. I think through today we'll be up to 80%. So in a word, the earnings season has been strong. About 80% of companies are beating estimates. And in the aggregate, we're probably going to see double-digit earnings growth year over year in the second quarter. So the headline has been strong, but I think when you look underneath the surface, things are a little bit weaker. If you look sector by sector, there's actually only 4 of the 11 S&P 500 sectors that are significantly beating their estimates coming into the quarter. So those sectors are financials, tech, communications, and consumer discretionary. And then in particular, most of the outperformance for those sectors is really being driven by the Magnificent Seven. So the Mag 7, on average, have delivered about 20% or more earnings growth this quarter, and the rest of the 493 businesses in the S&P 500 have really only grown earnings in the low single digits, about 2% coming into the quarter, and maybe we'll end up around 4%. But obviously, that's much lower than the growth that you're seeing from the Magnificent Seven companies.
So, Michael, given the backdrop, the environment we find ourselves in, let's look for some opportunities here. Let's get to some names, some picks. Why is McCormick a buy?
Sure. So McCormick Consumer Staples Company, this is a conviction position for us in that sector. So they've got a dominant position in the spices category. If you go into any grocery store, all you'll see is McCormick. So they're very resilient to the economic cycle. When the economy slows down, consumers tend to spend a little bit less on snacks in the center of the store. They tend to shop the perimeter more, buy more whole foods, and use more spices. They've also got good secular trends as well. People trying to eat healthier, eat better. There's also some potential upside from ingredient reformulation. They have a segment called Flavor Solutions where they work with companies to reformulate their ingredients and to give consumers more options, healthier options. And then finally, it's just at a really attractive valuation. This is a company that traded at a significant premium to the U.S. food industry for many, many years. And just given how weak the staple sector and defensive sectors more broadly have been in the market this year, McCormick is now trading roughly on par with the other U.S. food companies out there. And we think that this is a company that returns to a significant premium over time as their business is just that much better.
Michael, here's another one you like, TJX, which is up roughly about 10% in 2025. You say that one's going to keep moving higher.
That's right. So TJX, they own and operate not just TJ Maxx, but also Marshalls and Home Goods. And so well-known discount retailer. It's a great place to shop for consumers that are really looking for value. I think what's underappreciated about this one, though, is more on the home goods side of things. So if we do end up seeing, rate cuts start in September and we see a reacceleration of that rate cutting cycle that is currently on pause, that home goods store could actually see a significant uplift there because that business is levered, not just to new home sales, but also existing home sales. And we could see that pick up with lower interest rates here. So we think that could give the stock an additional boost in the coming quarters if we see that.
One more name I want to squeeze in here, Michael, Copart, CPRT is the ticker. It is down about 20% so far this year, but you think that's an opportunity?
Right. So this is more of a contrarian call for us. Copart's very high quality business or in the car auction and salvage business. And, you would think that with all the technology going into cars these days that there'd be less accidents and those accidents would be less severe. It's actually not the case. Accidents are still just as frequent as they've always been. And since you've got so much technology in the cars, even a fender bender can result in a total loss for vehicles. So strong secular growth over time. The stock did sell off after they reported their most recent quarter. due to concerns around market share loss, specifically Copart losing share to their biggest competitor, IAA, Insurance Auto Auctions. We think that was just due to Geico, which Copart does more business with, losing a little bit of share, some volumes to Progressive during the quarter. So we don't think that's a trend that's going to continue. We think that reverses. And so Copart's at a very attractive price here to get in for long-term investors.
Michael, appreciate your time and those picks. Thank you, sir.
Thanks, Josh.
Jessica, I want to turn to you too. We're talking about earnings. We were talking about valuation. What about sentiment? What about positioning? Jess, what do you see?
Yeah, so it's still rather narrow. And so what I think is interesting about positioning, if we talk about what's leading or looking like leading the rally right now, which is those AI stocks, it's very hard to find an AI bear. That's concerning for me. Now, there was a wonderful stat by Bank of America that pulled together all of the Wall Street consensus, and positioning is still really low for equities. And that tells me there's a lot more room for
Where is it at, Jess?
It's like somewhere underneath about 60%, which is not, that's not very high whatsoever. So if there's still this fight for what's happening in the fixed income market or allocating assets elsewhere, from a positioning perspective, that still leaves room for upside. But then that also begs the question, is there something under the surface that is of concern? But as more of that contrarian indicator, if you will, if we don't have high positioning, that means we can't call a top at those moments either, because there's more room for reacceleration. It's all a function of supply and demand. There is a function of demand that hasn't been implemented yet into the market, which is a positive catalyst.
So, let me ask you this: when you, as you know, under the surface, looking for some reasons for concern, what would be on your radar?
Anything that moves too far too fast is of concern. Right now, we've got yields are normalizing. That's very much important. Dollar, I do want to see the dollar normalize. The fact that the dollar is weakening and collapsing, it's accelerating a little quicker. I want to see that normalize. The fact that tech is moving so high, too far too fast, is all a concern. So what I look for is anything that even goes, if you go in the business cycle, any type of economic indicator, moving too far too fast causes something too far to the upside or too far to the downside, and then we have to normalize. So I'm looking for normalizations. Right now, the big one is actually the US dollar that I'm really key focusing on, but everything looks very, very narrow, which isn't necessarily a bad thing, but it's still concerning. And then that leads me just to understanding what is happening with corporations. And if you even think about, since the great financial crisis, corporations have been so resilient. We talk about the resilient consumer. Let's talk about the resilient corporation. They are navigating fiscal policy. They just have to understand the numbers and then can go from there. When we have tariffs come in, we're trying to understand that impact. Perhaps it'd go on this one specific product. Companies aren't doing that. They can't pass on 50% tariffs on prices. But what they are doing is being strategic, having upfront inventory. Where is that going to play out within the data? But also spreading it throughout different products, even that may not be impacted by a tariff, but that way it can soften the blow altogether, which I think is very interesting, and something that we're not really considering is how companies are really, really adapting. And we even saw that during COVID. One of the quickest recoveries we've had in a very long time, and we haven't had a downturn like that in a very long time. And since that long time, we've had an influx of technology, and now we're on another technological revolution. I think we have to understand that this adaptability that's happening across consumers and companies is compounding and is even going to be quicker now.
It is interesting, to your point, to hear, during this earnings season, to hear the C-suite and CEOs, and listen, you had to pick your spots, but it was a theme of listening to executives saying, listen, there are ways we could mitigate the tariffs. To your point, staying agile and flexible, talking about the different levers they thought they'd be able to pull, whether it's cutting costs or raising prices, or maybe leaning on their suppliers a little more. That was a theme.
Absolutely, it was a theme. And what's interesting, if you pull all the transcripts for at least an S&P 500 companies, it's not that we're cutting projects and we're stopping them, it's we're delaying them. Which then, again, is another momentum indicator. Once we have some clarity, that's the one thing the market doesn't like. Is uncertainty. Uncertainty leads to volatility. Volatility leads to higher term premiums. Just this huge domino effect that's not very good for a really just volatile, conducive market, if you will. But I think it's something that we have to pay attention to.
All right, we're going to hear from a lot more companies right after the bell. Russia earnings coming at us after the close. And we are just getting started here on Market Domination. Coming right up, Apple invests in America. That is the message from the White House. We're taking a deep dive into the multi-billion-dollar commitment. Plus, NRG stock seems to be losing some steam here. We're going to explain why. And a touchdown for Disney and the NFL. We'll be breaking down a big deal between them. That story and more coming up when we return. Apple is looking to invest an additional $100 billion in the U.S. manufacturing commitments. This comes as the tech giant continues to face pressures with the threat of tariffs to manufacture its iPhones in the U.S. Here to decode the tricky path ahead, we have Tufts University, Fletcher School of Law and Diplomacy, adjunct associate professor Gautam Mukunda, along with Yahoo Finance tech reporter Dan Howley. Dan, my friend, I want to start with you and give us a lay of the land, Dan, for Apple right now.
Things are looking up, at least for now. We have Tim Cook. He's supposed to join President Trump at the White House during this announcement in about an hour. And the big deal here is another $100 billion. That's on top of the $500 billion that they had previously said that they would spend in the U.S. This is related to manufacturing in some capacity. We don't exactly know yet. It's worth noting that they previously said that we would work with partners to work on a factory to build out their AI servers in Texas. That was part of that $500 billion idea. The other thing going on here is the Trump administration telling Yahoo Finance that the India tariffs would largely not impact Apple. And so that's a big deal because the iPhones that are destined for the US are built in India. And Apple kind of did this maneuvering when the original tariffs went into place, or the threat of tariffs went into place for China. China is still where they manufacture the rest of their iPhones for the rest of the world, but the ones that come here come through India. So you can imagine Apple probably wasn't excited at the prospect of 25% tariffs on goods from India. Trump had also previously threatened a 25% tariff on iPhones just because they weren't made in the US. So now with this $100 billion investment, it looks like they're getting back on Trump's good side. We'll just have to see how that plays out. I've discussed this before, but building a smartphone plant isn't exactly the same as setting up a car wash or a Wawa. It's a long-term thing. Also, shout out to Wawa.
Gautam, I want to bring you in here as well, my friend. Get your take on this news. And I'm looking at the stock, Gautam. It is surging nearly 6% in today's trade. What do you make of that?
Tim Cook rarely puts a foot wrong and demonstrates a level of political sophistication that his peers should learn from. The announcement is an announcement. It's giving President Trump what he wants, which is a headline. Will they actually do it? I mean, I don't know, and I'm not sure they know either. The parallel here is the major announcement during the first Trump administration that Foxconn was going to put $10 billion into Wisconsin. There was going to be factories. There were going to be thousands of manufacturing jobs. None of that happened. The state of Wisconsin spent hundreds of millions of dollars in subsidies. They generated, a handful of jobs and a showpiece thing that looks like a budget Epcot center, and no manufacturing jobs and no plants. But the headline was the big thing, and then everybody moved on and forgot about it, except, of course, Wisconsin taxpayers. Apple is doing the same thing. They're getting the headline. They're going to get their exemption on their tariffs, I'm sure. And Tim Cook is really good at this stuff. I think other people should sort of observe that. I wrote a column a little while ago saying CEOs need to understand, thanks to President Trump, this new world, CEOs need to understand politics as well as they understand financial markets. There aren't too many who do. Cook seems like he might be one of them.
Jess, I want to bring you in here as well. I look at the stock reaction as well, Jess, get your thoughts on this. I wonder, listen, there's all kinds of reasons it could be up today. Could it also be because if I'm an Apple investor, just bottom line, I am riding alongside Tim Cook, and hey, all else being equal, it's a good thing that Tim Cook and the President of the United States seem to be, right now, on good terms.
Sure, it's certainly a negotiation tactic. As we were saying earlier, Trump did say at some point that companies will pay for tariffs. Perhaps it's the investment in the U.S. that is leading to that. But what I think is interesting is price action. I actually have a very, very strong level of resistance around 215, which I want to see us surpass that, which is going to happen with earnings follow through. That's a very important component, or whatever Tim says today. We also need to digest that. But when I'm looking at price action, as in to give you more clarity of how strong of a moment that was formed from June of 2024 and tested multiple times. It was an area of support, and we fell through that. Old support becomes new resistance, which means from a psychological perspective, think about this from a function of supply and demand. If we have a lot of investors that own Apple around 215, it hits that price, you're more apt to have supply come in and sell, thus causing price pressure downwards. And that's what's happening right now with Apple. We're very close to that 215. Even though we have a lovely rally right now, there is this strong area of resistance that I want to watch to see if we have any additional upwards momentum.
Dan, mentioning this rally today, do you think it's also in part because investors, and tell me if you agree with this, they like the diversification, or at least the intent to diversification? I mean, Tim Cook's been doing this. Listen, I mean, obviously, I'm not minimizing it. China is still a key link in his supply chain, but he's making moves to India, to Vietnam, and maybe investors also like to see, hey, you're also broadening a footprint in the U.S. too.
I think that's part of it. I think that honestly, the big kind of thing that stands out is truly getting on the president's good side and potentially dodging these tariffs from India. That's not the last trouble spot for Apple, though, at least with regards to the government. They also have to be on the lookout for those Section 232 tariffs that President Trump says are coming within the next week. We don't know how those are going to play out. We don't know if it's going to be on raw semiconductors, on semiconductors in devices, what devices could be tariffed as a result of that, how they're going to do the tariffs. Are they going to do it on the whole device? Are they going to do it on just the value that the chip adds to the device? How many chips will be part of that? Because look, an iPhone isn't just a CPU, it's chips for a whole bunch of products, pieces of that product. And so, that's the other big matter going on right here. So I think, obviously people are kind of exuberant at this moment just because of this thought that, hey, maybe Apple's, out of that shadow that they might have been in for a bit, but they still have to look forward to the Section 232 issue. Tim Cook had said on the earnings call that when he said that there would be $1.1 billion worth of headwinds as a result of tariffs, that did not include anything to do with Section 232 on the last earnings call. So obviously they're kind of just waiting like the rest of us.
Gautam, we do expect Trump and Cook to make this announcement later today. When we see them together, Gautam, what are you listening for there?
So the answer, frankly, is not much. This administration has a sort of a central problem. To quote Ronald Reagan in one of his great lines, the right hand and the far right hand often don't know what they're doing. So Section 232, if you look at it, it's very easy to write a Section 232 report in such a way that it gives the administration what it wants. And the problem that I think Cook and certainly many other CEOs are encountering is just at least partly because of the way this administration is staffed, it doesn't have policy coordination. Different policies are cutting in different directions in really profound ways. So these tariffs are supposed to bring manufacturing into the United States, and maybe, there'll be some final assembly, but this is sort of a basic misunderstanding of how complex supply chains are, that the sort of rate limiting steps in iPhone production, critical things like chips, those still aren't going to be made in the United States. And the only way they could have been is through the CHIPS Act subsidies that the Trump administration zeroed out. So I suspect they'll be very friendly. They'll be very buddy-buddy. But next week, the administration might do something that contradicts all of its current policies just because no one is sitting down and working the policy process to make sure that everything lines up.
I guess on that point, Gautam, I'd be curious. Trump has pushed Cook, hard on this idea you should be making the iPhones here. We have had any number of, Apple analysts who come on the show and say, that's not exactly financially tenable for Cook. I'm wondering, and I'm asking you to speculate here, but after this announcement, after this headline, do you think Trump backs off that?
I think he'll just keep saying it rhetorically, but whether he'll actually do policy enforcement, Apple is one of the handful of companies that has a level of stature that if things go really wrong, it will have political consequences, right? If the next wave of iPhone released in September is messed up in some way, in a way that's directly attributed to Donald Trump, people will care about that. That will actually, it might be the only consumer product in the world. Well, that will show up in his numbers. That will affect Republicans who are trying to run for re-election going in next November. So there aren't many companies that they'll be cautious about. Apple might be one of them.
Godem, Dan, thank you guys. Appreciate it. Coming up, we're going to break down some of the top trending tickers on Yahoo Finance. Stay tuned. Now time for some of today's trending tickers. We're watching shares of NRG, Amgen, and Arista Networks. I'm joined by Jessica Inskip, stockbrokers.com Director of Investor Research, to break down these moves. Jess, let's start with NRG. Well, that stock is down hard today. The company announcing it will provide 295 megawatts of power to data centers in Texas. It was an underwhelming agreement in comparison to recent deal announcements from competitors. That did seem to be the issue. I did see analysts cited as saying, good first step, but investors were looking for more here.
Yeah, well, that really dampened consumer sentiment, which I think is causing the downturn. From a price action, when I pull up the chart, the first thing I see is something called bearish engulfing, which is very concerning.
It sounds concerning.
It is, and we've broken, so I like to look at the 13, 26, and 40 weekly trends, which is very different from a technical analyst perspective. But the reason I do that, the 13-week represents 1 quarter worth of prices, 26 to 43. We look at the market quarterly. We want price action to follow its earnings follow through from a technical perspective, if you will. We broke through that first line of defense with bearish engulfing, which is indication of consumer sentiment and what we're seeing today, but that means there's more downwards pressure there. Digging into the earnings, they slightly missed it, but there's an 8% year over year increase. That's great. And there's data center demand, like we've been talking about. The spending is with the hyperscalers. That spending is AI expansion, but we also need energy for that. So I would look for an area of support and then add actually to my position with this. And that next level is actually from that gap up that we had in May around 120. So if we fall to 120, I'd add to my position.
Bearish engulfing.
Bearish engulfing.
Check out this one too. Amgen shares, they're falling despite a top and bottom line beat in the second quarter as investors look to future reports on the company's obesity drug. So this one, the report results for the second quarter. I did see analysts at Citi cited as highlighting uncertainties regarding the competitiveness, they said, of the company's obesity asset, Maritide. Apparently data expected there in the fourth quarter. TD Cowen has a buy. They did say we continue to like the risk reward given the broad growth portfolio and relatively, they said, guarded expectations for Maritide. But what do you see?
Well, so a strong quarter, and I think maritime is something that's going to really help this company. So we want to see that absolutely follow through. But the risk here seems more policy and tariff related. That's very interesting to me because it's the theme now of tariff might be the word of the year, if you will, which goes
for sure
with uncertainty. But the fact that that's actually feeding into these earnings here and leading to that uncertainty, like we were saying at the top here, if we have a number, we can understand and we can prepare. They don't have that ability for preparedness, and that's showing within these earnings, and that's concerning to me. So this one is not something that I would buy. I'd want to see more come through with what's happening within that company because that drug is their catalyst, but there's increasing competition there. Something of concern. All
right, final one I want your take on here. Arista Networks soaring. New all-time highs there following the company's second quarter earnings release, which included revenue forecasts for Q3 that beat estimates. This one, I did see KeyBank. Now, they like this one. I see them cited as saying that the Analyst Day coming up on September 11th likely helps put to bed key debates, highlights emerging opportunities. What do you see?
So this is where we see that CapEx really, really catching up, and that is great for this. So the AI demand and cloud infrastructure demand is something that they're benefiting from, and we're going to see more of that. And so I like Arista for that reason here. Good beat across the board from cloud and non-cloud, and that's very important. We think about what you need for AI. We need good data, but we need data that's accessible that happens to be on the cloud, and they're going to absolutely benefit from that. So great earnings overall, but it's the tailwinds. We've got Meta, Microsoft, Oracle, all of the spending, and that's certainly going to help them. Where is the money flowing? That's all we're looking for, and it looks like it's flowing with Arista.
Follow the money. There you have it. All right, meanwhile, Disney has announced it's given the National Football League a 10% stake in ESPN. Yahoo Finance executive editor Brian Sozzi asked Disney CFO Hugh Johnson about the strategy behind that move.
We feel terrific about the assets that we'll be getting for the deal. The combination of the NFL Network and all of what that brings, in addition to that, combining our fantasy football business with the NFL's fantasy football business, plus the ability to market Red Zone. Overall, we feel terrific about that. And obviously, there's 3 additional games we'll be getting as well, which are of significant value to us. So as we think about it from 2 perspectives. Number one is the impact it's going to have on the ESPN DTC business, which we think will be super positive. And then second, obviously, putting the NFL Network together with ESPN will create both revenue and cost synergies. The outcome of that from an investor perspective is it'll be accretive by about $0.05 before purchase accounting. So we think it's a great deal for the NFL, and we think it's a great deal for ESPN as well, which is the best of all worlds.
Hugh, I've seen ESPN various estimates in terms of valuation, $25 billion, even as high as $30 billion. That would make this NFL stake up to worth about, what, $3 billion? Is that correct? Do I have my math right?
Your math is correct, although we haven't talked about the value of ESPN or the value of the assets, because what we're doing here is exchanging equity in ESPN for the assets and the income streams that we're getting. So we haven't really put a specific valuation on it. As I said, the thing I can tell you is it's accretive to the Walt Disney Company. So from a financial terms perspective, we're very happy with the financial terms.
Hugh, as you know, Red Zone has a sacred following, very passionate base in terms of that programming. Do you and Bob Iger, CEO, do you envision ESPN talent going onto that platform?
You know, we haven't talked about it at this point. It's probably a little bit too early for us to go there. I know the guy who hosts ESPN, a fellow Syracuse University graduate, by the way, does a fabulous job. So I certainly expect us to continue and, if anything, try to be additive to that capability, because it's such a good one.
Now, the deal, of course, has to get approved by regulators. What is Disney willing to give up to get this approval from the Trump administration, which has not hidden its views on traditional mainstream media?
Well, I'm hopeful we're not going to have to give up anything, to be honest with you. We don't see it as in any way anti-competitive. Actually, quite the opposite. The way we think about it is this is so pro-consumer. It really makes their lives easier. Sports fans, it's a bit of a challenge right now because content is spread across so many different places. And we view this as a convergence that we actually think will make it easier for the sports fan, and in addition, it'll give them the capability that we have as ESPN to produce fantastic content. And in addition to that, with the ESPN DTC launch, we'll be able to bring a lot of new capability as we innovate for the consumer as well around things like multi-view games and personalization of SportsCenter. And in addition to that, fantasy and betting and enhanced statistics. So we view this as super pro-consumer and are certainly positive from that perspective. And as I said, we think it's a great deal for the NFL owners and the NFL players as well. So this is truly a win all around. We're hoping that the regulatory process will go extremely smoothly.
Hugh, $1.6 billion for a 5-year deal for WWE. I'm a WWE fan. It's good to see WrestleMania and other events being on one home. What's the return on investment you're looking for? That also is a very large number.
Yeah, it's a big investment, but we do expect positive financial returns from the investment. So from that perspective, we haven't gone any deeper than that. But the beauty of where ESPN right now is with the NFL, with the NBA, with college football playoff, SEC, and NHL, we have so many, such a good load of volume of really high quality content. We can pick and choose where else we want to be. And as a result of that, we're in a good position to strike good financial deals for ourselves. So we expect this to be another good financial deal for ESPN.
Coming up, French fries, wings, and coffee. Oh my, we are delivering your playbook for restaurant investing. Stay tuned. Names in the restaurant space are in focus this earnings season. McDonald's reporting second quarter results on Wednesday, providing key insight into the industry for investors. McDonald's posted a beat on the top and bottom lines and reversing its U.S. sales slump. We're navigating how to play the restaurant sector with the Yahoo Finance playbook. Joining me now, we got Andy Barish, Managing Director of Equity Research at Jefferies. Andy, always good to see you. So let's start there with McDonald's because they reported, Andy, investors seem to like what they heard. I see the stocks up here more than 3% in today's trade. I know you like this stock. You're a believer. What did you make of the print, Andy?
Yeah, good afternoon, Josh. Thanks for having me again. Really solid and just kind of building layers and sustainability to the U.S. same-store sales, I think was kind of the theme, even if the lower-end consumer, continues to not be great. If McDonald's is winning on value and everyday affordable prices, they are going to be a share taker and will continue to drive those solid and accelerating same-store sales in the U.S., which should continue to drive the stock higher.
Andy, in my house, McDonald's is a hit. My 6-year-old is a fan. In terms of product momentum, does McDonald's, Andy, have new product in the pipeline? Is there innovation coming that's going to excite that 6-year-old?
Yeah, this brand's as relevant as it's ever been, and you're going to see in about a week or so kind of a nostalgic return to McDonald's land and some of the characters that maybe you and I grew up with, the Grimace and the Hamburglar, and some interesting innovation around beverages, meal deals. Clearly, the chicken snack wrap that launched about a month or so ago has been performing very well at a $2.99 price point. We'll probably see, Chicken Big Mac make its return in the fall. And yeah, a lot of innovation that, continues to focus on chicken primarily, but also potentially some beef items as well as beverage items that they'll be testing, as we work our way into the end of the year here.
There's a broader question, Andy, I had for you relating to your space and some of the names you cover, like McDonald's. When RFK Jr., Andy, was nominated and then approved to lead HHS, there was a lot of hot talk, Andy, including I remember some analysts who came on the show who said, oh boy, if you are making salty, fried, delicious food, Andy, you might have some problems here. What happened to all that? Was that ever a legitimate risk for investors?
Not really. That's, seemingly been focused on the food manufacturers and obviously certain areas like colorings and dyes and things like that. Restaurants, did come into the scope of the GLP-1s 2 summers ago in the summer of 23. And there certainly was some impact on the stocks. They did bounce back, kind of that fall, but and we really haven't seen any noticeable changes in operational trends or anything as GLP-1s now approach, I guess, about 5% of the population. So we'll have to continue to monitor that. But no, the Make America Healthy Again has kind of kept away from the restaurant industry, given the choices and variety that restaurants provide. And, the GLP-1 saga will continue to see unfold. But, overall, chain restaurants continue to gain share, and the category overall gain share in total food dollars when you include, food at home and food away from home.
Andy, we talked McDonald's. Here's another name, Dutch Bros. Earnings on deck. I'm curious what you expect to hear there, Andy, and why you say that one's also a buy.
Just a company that's really had a great concept and culture and now has kind of added to the management team and really built kind of sustainable sales layers that are winning in the marketplace. It's focused on cold convenience, customization, and most importantly, maybe it's broistas, as they call them, making connections with the guest and kind of brightening that guest day, in addition to serving them a fun, customized drink. So I think the category's got a lot of growth and tailwinds. Dutch Bros is approaching the category in a way that continues to win, and I think we'll see, a continued sort of beat and raise scenario tonight, as they've had a lot of momentum in the business and a lot of sales layers that should continue to drive, good results. Some of the best unit growth in the category as well. Looking out to 2026 and beyond.
Andy, here's another one I need your take on. Very curious. Starbucks. There are a grand total, Andy, of just 5 cells on the street when it comes to that name. You're one of them, Andy. How come? How come Starbucks is a cell here?
Yeah, we just think it's been really hard to kind of get your arms around the numbers. There are no guardrails or guidance just yet. We really respect Brian Niccol, but I think this was a situation where a lot of the investment community kind of got a little bit excited ahead of any of the results. And what's become clear, we initially downgraded the stock and, kind of went from 110 to 80. We upgraded it at 80 to a hold. When it got back to 95, we went back to an underperform. And I just think it's sort of expectations have gotten ahead of the reality that this is a difficult foundational, operational, cultural turnaround that eventually will take place. It's just needs to kind of build some baseline before you can kind of see this business grow again. And we're still kind of searching for what that earnings bottom may be. And when you're going through that, it's just hard to value the company and hard to really, kind of buy into the turnaround just yet.
Andy, always great to see and to have you on the show. Thank you.
Have a good one.
Jessica, turn to you. Your thoughts on the restaurant sector. What are you seeing?
Yeah, so I do want to comment on McDonald's real quick, because I read on their earnings report. I thought it was very interesting. Their technological investments are really...
It's not just Oreo McFlurries.
That's right. It's not just Oreo McFlurries, but that's just an adaptability that's happening within these corporations, and I think that's very important. I like to look at price action. There's an ETF, doesn't have a lot of volume. It's EATZ, E-A-T-Z, it's the only one that is primarily in the restaurant industry.
E-A-T-Z.
E-A-T-Z, yes. So it's about 5% of it is Darden. It's got Nathan's in there, DoorDash, Cracker Barrel. So it's a gauge of at least the restaurant industry. That's showing some bearish divergence for me, which tells me maybe restaurants as a whole might be coming down even further because of the price action. And that's something to be of concern. So I think we could filter that into maybe even economic data. I think about what was happening with the Fed speech recently and what's happening with even the consumers within the services industry and seeing that deaccelerate. Where is that translating into earnings? I like to marry those two together. And this is actually mirroring what I heard Fed Powell say, because now we're focusing on goods again.
Yeah.
So I think that's just interesting overall. But the McDonald's takeaway with the overall performance to me is the technology aspect. That's the theme with this narrowing rally. And even if it's not AI, technology, the reason why we like AI is because we can do so much more with less. So if you can have an investment within technology that leads to higher productivity, a better experience.
You're a big believer in the AI productivity fuel thing.
I absolutely am. And we can see that. We pull the productivity numbers. You can see it going through. We can see that come through with the data. Now we're seeing some revenue. It's not widely spread just yet, but it absolutely will be, and we're still in those early stages.
All right, we'll keep watching. Thank you. And while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.